All right, good morning, everybody. Thank you for joining us this morning. It is 9:30. We have a couple of people still joining, so we will give them just a few minutes, but I appreciate you joining us today for our 2021 tax review. Just a couple of housekeeping things before we get started. We are recording today's session, so if you want to keep your camera off, that's perfectly fine. We do not have to see you today because you're not receiving any type of CE credit, but you're also welcome to keep it on. I just like to let people know. We will do a question and answer session at the end. So during today's class, if you have any questions, you can go ahead and put those in the chat as we go, and then we will answer all of our chat questions, or you can unmute at the end of today's session and we'll do a Q&A question at the end to make sure we answer all of your questions. And if you would keep your microphone muted during the session today, unless you have a question, that way there's not any background noise and we can hear our speaker well. So I'm going to go ahead and introduce our speaker today. His name is Nick Clark, and he's from Strojny Financial Services. Nick has been with the company since January of 2018 and currently works in the Gulfport office. He has a Bachelor of Accounting and a Master of Business Administration from Mississippi State University. Nick assists with small business accounting, personal and business tax preparation, and financial planning for clients not only in Mississippi, but across the United States. As a lifelong Mississippi Gulf Coast resident, he is especially excited to assist his local community with their tax and financial needs. So let's welcome Nick.
Thanks. Yeah, so I'm excited to be here for you guys and share a little bit of the tax changes this year and help you set your business up for success this current year. So just a couple of things we're going to touch on today. Like I said, just a few new things this year: the child tax credit, and of course the stimulus, the special charitable donation deduction, and as well as some QBI that you guys can take advantage of. And then lastly, we'll wrap it up with just ways to start a business and some potential tax saving strategies with entity structure selection. So, and then like she said, we'll have some questions and answers at the end there for you. So just jumping right into it, one of the biggest changes this year was the enhanced child tax credit. What they did for this year is they increased it from $2,000 per child up to $3,600 depending on the age of that child. And they also decided to pay half of it up front. So if you have dependents and you receive that monthly installment from July to December, that's what that was. And so one thing to note on that, if you are used to claiming $2,000 on your tax return, because they paid half of it up front, you could potentially see a little bit less of that flowing through to the actual tax return. So for example, we'll just look at the 6 to 17 bracket or age group. $3,000 is what you received. However, they paid $1,500 of it up front. So if you're used to claiming $2,000, and then this year you're only going to see about $1,500 on that return. So that could be a little bit of a reduction in some of those credits on your actual tax return. But overall, they did increase that. So you guys will be able to take advantage of that if you have dependents. And if you didn't receive it, then you'll have the full amount on that tax return. So they did send out IRS letter 6419 on those. If you file a joint return, they were splitting those between you and your spouse on there. So just make note of that. And that is one of the things you will need to get your taxes filed this year. So the other big thing, was a stimulus 3. Now, this was issued in early March of 2021. It was $1,400 per person on the return. Again, if you never received this for whatever reason, there is a way to claim it on the tax return as the recovery rebate credit. It's the same thing as last year's when we had stimulus 1 and 2. This one just happened to fall in this year, so you'll be able to take advantage of that. And again, that notice they issued out, which I believe they're sending out those here recently. Some of our clients are dropping those off. It's IRS notice 1444C. If you don't have that, it's not that big of a deal. As long as you know that you received $1,400 or have that amount. But just be aware that they are issuing those notices out to you. And then one thing to note as well, if you have a dependent that's filing as themselves this year, and you got paid for their $1,400, or if you were overpaid for whatever reason, you aren't required to pay back those funds, any excess. So moving on, the PPP loans and EIDL loans, most of these fell into 2020, but I just want to kind of reiterate some of those rules again. If you did get any of these in 2021, PPP funds are not taxable to the entity that received them, and you also don't have to reduce your expenses for the amount of that loan that was forgiven. Same thing for EIDL grants, and loan proceeds are not taxable, so you don't have to worry about reporting those on your tax return. And then if you did receive any SBA loans or loans where the SBA was paying a portion or making payments for you over a period of time, note that that income is taxable to you. That does have to go on the return. However, you are allowed to deduct the interest that they paid for you on that. So be sure you take advantage of that. One of the new things that they had that started last year was a special charity deduction. Before, in order to claim charitable deductions, you had to itemize, and in order to itemize your mortgage interest, real estate taxes, car tags, charity, all of that had to add up more than the standard deduction, which now that they've doubled it to roughly $12,000 for single filers and $24,000 for married filing joint, that's a pretty large threshold to overcome. So what this special deduction allows you to do is claim up to $600 for married individuals and $300 for all other filers, as a line item to where you can deduct that on top of the standard deduction. So if you are contributing to 501c3s or any other charitable organizations, you're able to claim a little bit of that, up to $600. Now with the QBI has been around now for a couple of years on your tax return, so a lot of you are probably familiar with this. It was a new deduction where you can deduct 20% of your business income on your tax return. There are phase outs for this depending on your income, but it is a really good deduction that business owners are allowed to take. So you just want to make sure that you're claiming that if you're operating as a sole proprietor, partnership, S corporation. The only entity structure that doesn't allow for this is the C corporations. And then also, if you do have rental homes and you have those on your tax return, there are ways that you can claim QBI for that. Most of the time, rentals fall into passive income categories where they aren't operating necessarily as a business. But if you are operating as a business and you have some income flowing in from that, in order to claim QBI, you basically have to have separate books and records to be maintained, 250 hours of rental services performed annually, and those don't necessarily have to be performed by you. They just have to be performed on that particular rental home. And that includes advertising, negotiating leases, rent collections, and just your day-to-day operations of that. And then of course you have to have that extra record maintenance with logs of all those hours performed and everything like that. So if you have all that, you're able to claim that deduction for rentals as well, which can be a pretty significant tax savings for you. So those are kind of the new things on the tax return this year to kind of note and be on the lookout for when you're filing this season. Moving into maybe some tax saving strategies for this coming year in 2022, different business structures and entity selection can, help you save a little bit of taxes depending on how you structure that. So I just wanted to go over, if you are starting a business or, somebody's told you, hey, you need to form an LLC, you need to do this, you need to do that. I'll kind of go over that process so you're familiar with that. So to get started with a business in Mississippi, first thing you'd want to do is check with your county tax collector and just make sure that, any licenses that you need, you register for those. Once you've done that, you can register your business with the Secretary of State. There is a little bit of a filing fee with that. I just want to say it's roughly $50 or so to register with the Secretary of State. Once you've done all that, you can register your business with the Department of Revenue. And then lastly, you'll obtain your IRS employer identification number. Once you have all of those things, you can then, go to the bank, set up a bank account and kind of get that separation, from yourself. So you have basically a complete separate business entity. So there are, multiple entity structures that you can, set up. LLC being one of them, S corporation, you can operate as a sole proprietor. There's C corporations. So the question, how do you know what type of structure that you should be? So I created a little cheat sheet for you guys here to look at, and highlighted some of the important things to note. So single member LLCs, basically they operate in a similar manner to sole proprietorships, in that they don't have a separate tax return, and you just file, on the Schedule C, just as you would as a sole proprietor. One thing that's different from them, you do get, that employer identification number. So instead of having to use your social security number for everything, you do get the benefit of kind of masking that and using, a business EIN from that. And also you can set up that separate bank account to kind of keep track of expenses and everything, and make it a little bit easier for you to, compile some of that tax information that you need for the end of the year. Partnership is another entity structure. If you go into business with, more than one person, you can look at establishing a partnership. That one does require a separate tax return. And then, S corporations and C corporations, more often than not, we typically don't recommend C corporations for small businesses for the simple fact that you get hit with double taxation. And what I mean by that is the C corporation not only files its own tax return, but it also pays its own tax. And then any distributions and money flowing back out of the corporation to yourself as an owner is also taxed on your personal tax return. So you kind of get hit twice there. So in some cases it does make sense, and there's some other reasons why you would set that up. But for most people in small businesses, we typically don't recommend those. The corporation structure that we do recommend, once you reach a certain income threshold, is the S corporation. It's a flow-through entity. You do have to file a separate tax return, but unlike the single member LLC and the partnership, as you can see here, it's not subject to self-employment tax on the earnings, which self-employment tax is basically the employer and employees portion of, of Social Security and Medicare wages, and that's 15.3%. So that's a pretty significant amount, of tax that you can save by creating an S corporation. However, there are some more admin or administrative tasks that you have to, have along with that S corp, such as payroll and, extra bookkeeping and record keeping for that. So just depending on your income threshold or your income revenue coming in, it might make sense for you to kind of look at that and, start saving a little bit of that self-employment tax there. So, and then the last thing to note, all of these structures, there is some sort of retirement plan that you can set up, whether that's a pension plan for yourself, an IRA, solo 401ks. There's plenty of options that we can look at, or that you can look at, and decide which one would be best for you and your company. But that's something that we do here as well at Strojny. Myself and I would say about 5 other advisors are not only licensed for tax preparation, but we also have those financial licenses to where we can advise you on financial planning and retirement needs as well. So that's something we can help you with throughout the year, setting those up, as well as tax preparations and filing. So that's kind of what I had for today. I know that's a lot of information, a lot of changes, on the tax return this year. And then, some tax planning strategies, potentially setting up some of these corporations and business structures, might make sense for you in the, this coming year to save on next year's tax return. So with that, I'm going to turn it over, for some questions and answers, and we can kind of go from there.
Okay, thank you, Nick. Does anyone have any questions they want to put in the chat, or you're welcome to unmute yourself, and we can, maybe a question that everybody has, Nick can answer for y'all. Cassie, I see your hand raised. You can go ahead.
Hey, Nicholas, thank you very much. I wanted to hey, you guys hear me?
We can hear you, yes.
Yeah. Mm-hmm.
Okay, my question was, I've heard a lot of chatter about basically there not being deductions for like entertainment type expenses. And as a real estate agent, you know, different lunches and open houses and things like that. Like, is there kind of another way to like code that expense, or it's just not going to be eligible at all now?
So yeah, they did get rid of a lot of the entertainment expenses. That's a very good question. That changed with the Tax and Job Cuts Act back in 2017. So it's been a little bit with that. So they did get rid of the entertainment expense. If you are attending some of those luncheons and things like you said there, you know, you could kind of code those and, you know, potentially, you know, continuing education if, you know, CE's offered or, you know, something like that. It just kind of depends on what it is. There are some places that, you know, you can kind of look to put some of those things depending on what it is. Meals, you know, you're still able to claim meals. So, you know, if you do go to a luncheon, you may be able to put it there. It just kind of depends on what you're doing. With that, I know you guys are, like you mentioned, you're going to a lot of those things. I mean, if you are traveling for those conferences, of course, you know, the travel portion will be deductible as well. So you can kind of code it in there. So I know that doesn't really answer your question. I hope it helps a little bit, but it's just hard, and it just kind of it's specific to what exactly you're doing that you may be able to put it somewhere else.
Okay, thank you.
Okay, we have a question here in the chat. Melissa says, this is my first year as an independent contractor, and I'm having trouble understanding the difference between my income tax and the self-employment tax. Just needing clarification on understanding. So the 15% self-employment tax is for Social Security, Medicare, etc. And then there's another figure depending on the tax bracket for the actual income tax.
Yeah, so as a independent contractor, you know, you'll receive that 1099 at the end of the year, and you'll be filing, if you're just operating with yourself, you know, a Schedule C business form. So with that, you're able to, you know, obviously take all of your deductions, mileage, you know, any other licensing stuff that you guys have on that. So, you know, once all of that's, you know, come out there, so let's just say you start, you know, at 50,000 with expenses, you have 25,000, you'll have, you know, a $25,000 business income. So that business income is subject to self-employment tax, which is the 15.3%, like you mentioned. That is basically just you paying into the Social Security and Medicare system. Just like when you're on a W-2, if you've worked a W-2 job before, they withhold those Medicare and Social Security taxes for you. And that company also matches that portion that you're paying in. So because you're an independent contractor and they're not taking out any taxes, that is why you're subject to that tax on that income. And so that's just that extra tax down there on a separate line of the tax return. And then the individual income tax is just, you know, the regular tax that, you know, everybody else has to pay, just like on W-2 wages. And that, you know, depending on your income threshold can range, you know, from 10 to, you know, 30 or so percent. So there are two separate, like I said, but that self-employment tax is really just paying into the Social Security and Medicare system.
Thank you. Actually, Neely asked, what is the QBI deduction?
So going along with that business income example that I used, where you have that 25,000, you know, flowing through in the business, the QBI, they allow a 20% deduction of that. So it usually shows up, you know, kind of after your standard deduction there, and you're just able to claim, you know, 20% of that as an extra deduction. It was introduced again with the Tax and Job Cuts Act of 17. Basically, it was kind of to even out the playing field because C corporations got a effective tax rate deduction. They were paying, I want to say it was like 35%, and they got reduced to 25%. And so to kind of even it out for all the other entities that were established, they reduced that and gave you that extra 20% deduction to be able to claim. So if you are a contractor and you are on a 1099, you should be eligible to claim that, provided you're not over that income threshold, which is, I want to say, let me go back to that slide. off the top of my head, about 165,000 for single filers and almost 330 for married filing joint filers. So that is a good deduction if you are a 1099 contractor or have, one of those business structures like a partnership or S corp. You're able to claim that 20%.
Okay, thank you. I wanted to ask again to expand on Kathy's question. I know a lot of our members have expenses for like open houses. They buy, things for their open houses, like a food or decorations or things like that. I think she was kind of asking if any of those items are considered entertainment or if they would be able to be filed under something else.
Mm-hmm. So for open houses and stuff, those would be more of like supplies and stuff because you're using that, to kind of, stage the house and, sell it. So those expenses wouldn't necessarily be entertainment. Entertainment would be if you took a client, out on a boat or, something of that nature. If you're using the supplies and stuff to increase your sales or, something like that, then that would fall in, supplies or some other deduction on the tax return. Like I said, it's more so if you're, going out, with clients and spending, entertainment money there, concerts, whatever else you're doing for them, that's more of what falls into the entertainment category.
Okay, great. Thank you for that clarification. Melissa asked, is there a certain way I should be recording my mileage? I've been entering each business trip on an Excel spreadsheet by listing the starting point, destination, reason for travel, and total number of miles, but someone told me that I should be recording it by hand after I take the trip and I need to keep track of my odometer. Is that correct?
Yes. So basically the easiest way of keeping track of mileage, if you are doing it manually, keeping track of the odometer readings is always good, just so you have that, for record on your report. If you're, keeping track of each mileage, from point A to point B and recording it there, that's, usually sufficient as well. Just having that extra odometer reading is always good. So if the IRS, does challenge you on any of that, you have, extra stuff to show to them. Alternatively, I know there's a ton of apps out there, that do the same thing where they, record all that. And there is a place for you to put your odometer reading on there to claim that. So more information I've always found is better. If it gets challenged, we've sent in stuff to the IRS, and usually if you have those things, they'll accept it. Very few people, that we've sent in any sort of mileage log, they've, challenged or, trying to reduce. So if you're keeping anything, just make sure it has, the starting odometer reading, ending odometer reading, and then of course, your actual mileage and why you're going there and where you're going. So that's always good to have with that. And even if you're only keeping the beginning odometer reading of the month and then at the end of the year, that's always good too. But definitely, keeping track of those miles and having a log is good for tax purposes.
Perfect. Terry asked, what is the capital gains tax on flips that are sold after 1 year of ownership? And what about rentals that are sold after years of owning?
Okay, so I'll start with the rentals after years of owning. So the rentals that you're selling after a year, the capital gains rate, does apply. So depending on your tax bracket, that can be 0 up to 20%. Most people fall in that 15% category. Now, that's only on the portion above recapture. So when you're taking rentals and you're depreciating those, all of that money is essentially reducing your basis. And so whatever depreciation that you've taken in that home, you do have to recapture, and that portion is classified as ordinary income at your whatever income tax rate you're at. And then anything above that would be classified as the capital gains rate, and you would get that more favorable tax treatment. Now, on short-term flips and long-term flips, this topic has been up for debate on how those need to be reported. If you're in the business of flipping houses and you're doing it continually, basically that would need to be reported on a Schedule C income, which would be subjecting yourself to that self-employment tax. Even if it's longer than a year, it just kind of depends on how many you have. But in most cases, it would need to go, on that Schedule C if you're flipping it. If you're doing, one here and there, you know, and you're not, you know, in the business of doing it, you just kind of do it as it comes up, then, you know, you would treat that, and you would also get the, you know, the favorable tax treatment. So that one just kind of depends on, you know, how frequently you're doing it, whether it would need to be on a Schedule C or on the 8949 sale of business assets, and where you would get the capital gains rates on that.
Okay, thank you. Any more questions from anybody? We've had a lot of great questions. And as long as it's okay with Nick, I will share his slides today when we share our recording. That way you'll have his contact information and can look back at those things that he went over, because it is a lot of information to remember when it's not something that you do every day. So.
Sure.
Ashley asked, what are some deductions that you notice realtors forget about?
Let me try to think on that one. Of course, mileage, you know, that's the easy one. A lot of you guys know that one. Cell phone's another big, you know, deduction that you can claim. Things that, you know, may be overlooked, you know, just the small gifts and, you know, stuff that you buy to stage the homes and sell. You know, sometimes that gets, you know, overlooked. Trying to think of some other stuff that other people have that, you know, is forgotten. Those are really like the main ones, and the big tax deductions. Of course, anything that, you know, you're purchasing to help you make that, you know, sale or anything, you know, would be deductible, you know, from there in some way, shape, or form on the return. But yeah, miles, cell phone, supplies, gifts, you know, stuff like that. That's going to be your main deductions, you know, that we have, and that's what I see mostly on everybody's realtor, you know, Schedule C or, you know, tax terms.
Thank you. Melissa asked, what are the criteria for a home office?
Home office. So home office, a lot of people will take the safe harbor method on that. So you would need to have basically a dedicated space where you only, you know, perform that business area. So if you have like a separate room in your house, you know, where you have an office established, that you're doing, you know, listings or, you know, whatever else on that, you know, then you can claim that, and basically you'll get whatever the square footage is of that, and then, you know, whatever the square footage of your total house is, you'll get a percentage of that deduction on there. So you would just need to be using that specifically for business. You know, I know that's hard sometimes where, you know, you have an office with a computer, you may not, you know, use it every now and then for personal, but by the book answer, you would have to have, you know, an exclusive area where you only, you know, practice your business in that room to claim that deduction.
Any other questions anybody has for Nick? A lot of these questions I know applied to everybody. Melissa also asked, does the use of my cell phone for a personal and work affect that deduction? So should she have separate?
Yeah, so a lot of times if you don't have that separate business phone, you know, obviously you're using some of for personal as well. If you purchase a second line, I know some, you know, phones now you can have two lines on one device. Then that second line that you use strictly for that would be deductible. If you're not, if you just have one line that you use for both personal and business, then you would have to come up with, you know, a percentage of, you know, business use versus personal use. And you need to kind of keep track of that throughout the year, so you would know, you know, what percentage is deductible and what percentage would not be deductible. But a lot of times I found in realtors, you guys are on your phones a lot. You know, something that most of the time it's 75-25, you know, percentage for that, 75 business, 25 personal. But you know, just how frequently you're using it would depend on, you know, how much of that would be deductible.
Okay, thank you. William asked, how should I classify a second home being used only as an office?
That is a good question. So if it's a home that it's just a second home where you have in your personal name, I would have to do research on that one and double check, because I don't want to give you the wrong answer. I would assume it'd fall in the same category if you're using the entire thing as an office. you know, you could probably, you know, take the mortgage or, you know, rent or whatever you're paying for on that as a business deduction on the Schedule C. If it, you know, a second home, you know, maybe the square footage. I would have to double check on that. So I can get, you know, your email and I'll do some research and get you that, you know, correct answer. I just don't want to give you guys the wrong answer on that one. So I'll have to double check that.
Okay, thank you. Yeah, Will, if you have, if you want to email Nick or, you know, give him a call with that question, that way he can clarify for you. Melissa just says this has been very helpful. Thank you. Yes, you've answered a lot of great questions for us today. So.
Yeah, you guys have some great questions. So.
Anybody else this morning while we have Nick here with us? Okay, well, I don't see anything popping up. As I mentioned, I will share today's recording with all our members and Nick's slides. That way you'll have his confirmation. I mean, his contact information, and you can get with him. Oh, Terry, yes, when I share this slides, you'll be able to download them as a PDF and you can print them so you can keep them. So you'll be able to have that. We appreciate you, Nick, being with us today and giving us a lot of great information. Hopefully you can take this back while you're getting your stuff ready to file for 2021, and it will help you get the most out of your tax year. Anything else anybody wants to add? Okay, well, we appreciate you, Nick, and thanks everybody for joining us.
Yeah, I appreciate you guys having me and, you know, here, and I look forward to, you know, assisting you if I could be of help. Like you said, she'll share my contact information. You can email me, call me. I'll be happy to answer any, you know, questions that come up for you.
Okay, well, thanks everybody. Have a great day, and thanks again to Nick.